What is the description? What is the characteristics of the property, plant and equipment? It says that held for use in production or supply of goods and services, for rental to others or for administrative purposes. And this type of the characteristics, the description was also in the accounting standard 10 earlier, unrevised. So you should not get disturbed that it is almost IFRS. The definition is almost the same. Held for use in productions, the fixed assets or the property, plant and equipments are the business is purchasing it for use, not for sale. What is purchased for sale? That is called inventories, and which is covered by the accounting standard 2. Here it is that it is held for, when you are purchasing certain property, plant and equipment, you are purchasing it for use, not for sale. But it doesn't mean that you can't sell it. After purchasing, if you find that you have purchased a wrong fixed assets, it is not suitable, you can very well change it. Or maybe after 2-3 years you find that now it has become obsolete, better type of upgraded versions of these fixed assets has come in the market, you may like to purchase it and like to sell the earlier one, you can sell it. But at the time of purchase, there is no intention to make resale of that assets. So that held for use in production or supply of goods and services, for rental or others, or for administrative purposes. What is the meaning of for administrative purposes? You see, if there is a company like Reliance, they have got a factory in the different places, but they have a corporate office in Mumbai, and that corporate office is meant for administrative purposes, and that building may be owned by the Reliance, so that is a fixed assets, property, plant and equipment for the Reliance, and that's a building. Now that building is used for, not for productions, not for supply of services, but for the administrative purposes. And that's why what the definition of the, it includes the held for use in productions, in supply of goods or services, or for rental to others, or for administrative purposes. So that's the characteristics of the property, plant and equipment. Dear student, I will tell you some of the basic differences with these NDS, AS and NES, basic differences. Anyhow, they are not, you should not think that these NDS are totally different from the AS. No, they are not. As far as the somewhat of the framework is concerned, perhaps they fit in the same framework, little bit changes. But what is the basic difference? The basic difference is cost versus fair value. Cost versus fair value. Dear student, from your class 11, from when you started to learn accountancy, you have a certain accounting principles, which is based on the cost. If you purchase a plant and machinery, the fixed assets, you will be initially recording it at cost. And what is cost? Cost, what you have paid or going to be paid, or going to be what you have incurred or going to be incurred. So the cost means what you are going to pay. You will be recording the plant and machinery, which is the fixed asset, at cost. You have purchased that plant and machinery for 5 lakhs, so you will record it at 5 lakhs. But somebody may say, no, its cost is not 5 lakhs. Because the seller was in need of money and you negotiated him, you did a bargaining, he was selling this plant and machinery at 9 lakhs because he was in need of money, and that's why the seller sold you at 5 lakhs. Should you record it at 9 lakhs or 5 lakhs? Dear student, our principle is cost. It will be recorded at cost. Your cost is 5 lakhs. Irrespective of the fact that its market price may be 9 lakhs, its fair value is 9 lakhs, but we have purchased it for 5 lakhs, we will record it at 5 lakhs. Maybe in IFRS or in ES, we may be recording it at 9 lakhs, maybe. Because there are a principle, accounting principle in the NDS that you can record it at 9 lakhs also. Later on you can change it to 9 lakhs. But in our existing AS, there is no provisions for it. You record it at 5 lakhs, provide a depreciation on 5 lakhs. But under the NDS, if you are following some other accounting policies, you can substitute 9 lakhs for 5 lakhs at a later stage and provide a depreciation on 9 lakhs. That's the basic difference. Cost versus fair value. But dear student, now the first case study is goods purchased on 24th of February 2009 at US dollar 10,000 and rate of exchange prevailing at that time was 46.60. Exchange rate on 31st March 2009 was 47, that is the reporting date, and date of actual payment is the 5th of June 2010. So how do we record and the application, because this is a foreign currency transactions, and how do we solve these questions? The question asked is calculate the loss and gain for the financial year 2, 8, 9 and 10 and 11. I think this 8, 9 is, yes, it is 8, 9 and 10 and 11. So 8, 9 for the reporting period is 31st March 9, then reporting period 10 and 11, because these transactions will be settled the payment by making the payment on 5th of June 2010. Now how do we record it? The first entry which you have to pass at the time of recognitions on 24th of December, February 2009, 24th of date 24th of February 2009. The entry passes that goods purchased on 24th 2009, $10,000, exchange rate 46.60. You will pass the entry purchase account debit, that will be $10,000 multiplied by 46.60, and this comes your 4,66,000. Now the credit will go to the foreign buyer, foreign supplier, to foreign supplier. 4,66,000. So that is a foreign supplier that at the time of the recognitions. Now on reporting date, which comes after that, is the 31st March 2009. On 31st March 2009, because this transaction is outstanding and therefore it has to be restated. And how it will be restated? That the exchange rate prevailing on that date is 47. So 47 you have to credit this foreign supplier because the liability is $10,000. So the foreign supplier has to be given more credit because the exchange rate is 47. So it comes 4,70,000. We have already credited 4,66,000, 4,000 more, and debit will go to foreign exchange difference. Foreign exchange difference, and this foreign exchange difference of 4,000 will be ultimately written off in the profit and loss account, and we will pass another entry on 31st March 09, which I am not writing here, but please you do write that you will debit the foreign profit and loss account debit to foreign exchange difference 4,000. So that the impact of this transaction is that the profit or loss will be reduced by, and this there will be a loss of 4,000 in the profit and loss statement for the year ending 8/9. Now if you go to the, it says that you record and show the transaction for 10/11. On 10 and 11, because the payment is made on 5th of June 2010, liability appearing in the balance sheet as on that date is 4,70,000, presuming that after that there was no exchange variation because nothing is given in the questions. So 4,70,000, the liability appearing. Now 4,70,000, now what you will be debiting it, and payment is made of 4,75,000. The payment will be to bank 4,75,000. Supplier account, foreign supplier account will be debited by 4,70,000 because we have only credited it 4,70,000, and this 5,000 difference will go to again the exchange difference, and this exchange difference will be ultimately written off in the profit and loss account on 31st March 2011. You will pass an entry, profit and loss account debit to exchange difference. That will be 5,000 here.